So good people, welcome. This is KASNEB ATD Level 2 and this is a December 2021 sitting. December 2021 sitting, Financial Accounting. So question 1. Enumerate four reasons why an organization might provide depreciation for its non-current assets. Enumerate four reasons why an organization might provide depreciation for its non-current assets. So the truth is that owing to the continuous usage of the non-current assets, their value depreciates with time. Their value goes down. They tend to lose their value as a result of the wear and tear. They can also lose their value as a result of obsolescence. That is, new technologies coming and rendering the previous ones obsolete. They can also lose their value through lapse of time. They can lose their value through depletion, where if we are talking about mining, after some time, basically the minerals will go towards finishing. So we have all those are possibilities. And now here we just want to enumerate reasons why an organization might provide depreciation for its non-current asset. Number one, of course, is to ascertain the true value of the asset, because normally we provide depreciation so that at least we can get to know the value of the asset after a given period of time. The books of account needs to show the true value or the most probable value of the asset as at any given point in time. So depreciation keeps changing with the changing value of the asset periodically, of course. And then you also have for the purpose of replacement, because depreciation is just a provision. This is money that is set aside to be able to replace the asset when it's finally declared obsolete or worn out. So it enables replacement of the asset at the best possible time. So it enables the replacement of the asset at the opportune time. That is when the asset is declared worn out, of course, through the various ways that can make it lose its value. We've said that depreciation is just money that is set aside. So we set aside waiting for that time when the asset will be worn out, and then you can use that money to of course, replace the asset. It's also used to ascertain the true value, the correct profit or loss during the sale of the asset, during sale of the assets. It's used to ascertain the correct profit or loss on sale of the assets. Normally, we take the value of the asset, the historical cost of the asset, and then that is all will be on the debit side. And then we have the accumulated depreciation. I think we can just show it here. This is the asset account. If this is the asset account, we have its historical cost, say 100,000, and maybe if it has depreciated by 70,000, now the 70,000 will appear on the credit side, and then the amount that we are going to sell this asset at, say 45,000. So that at the end of the day, we have here 115,000, here 115,000, and the difference is 15,000. This goes to P&L as a gain, because we've sold it at a profit. We were supposed to sell it at 30,000. That was the value of the asset. So from this, you can see that it helps ascertain the correct profit or loss on sale of the asset. That is very important. Then number 4, it also helps us to get the true figure for profit and loss. So it helps us to compute the correct income statement. So it helps us to compute the correct, basically to come up with the correct income statement and statement of financial position. Helps us to compute the correct income statement and the statement of financial position that what we are saying in essence is that it helps us to compute the correct profits and loss situation of the farm, whether the farm has made a profit or if the farm has made a loss. So that is yet another importance for providing depreciation. And of course, sometimes, especially in finance, we use depreciation as a source of finance. Depreciation is used as a source of finance, internal finance. So it enables us to know how much money we can access from this account. The money is the depreciation is just money set aside. So it tells us how much we can access from this fund and use it maybe for a certain short period of time before we can replace that money back for its original use, which is to replace the asset when it's finally worn out. So depreciation is a source of finance. How far can we use it as a source of finance? Then the figure will help us to determine that if we have a depreciation, say, of, like in our example, we have 70,000, this is accumulated depreciation. It means this money is just somewhere lying and you can use it as a source of finance, then return it, of course, in due time before the replacement of the asset happens. It's also used to compute the correct, it helps us to compute the correct tax liability. Tax liability helps us to compute the correct tax liability. Of course, the authority, the revenue authority, will have its own measures, but we also need to at least have our own ways of computing the tax liability before we can apply the KRA. At least we need to also have a policy that will help us in guiding us in terms of our tax liability. So, how many points are this? Can go with the first 5 are very clear. Ascertain the time value of the true value of the asset, replacement of the asset in its due time, and then ascertain the correct profit or loss on sale of the asset, then compute the correct income, compute the correct income statement or financial position statements, that is knowing the profit and loss and the position of the business as at any given point in time. And then depreciation in itself is can be used as a source of finance. How far or the extent to which you can use that money is defined by the value of the depreciation. So those are 5 points. You can pick any 4 and we'll be good to go. Let's look at the next question. Describe 4 qualities of useful financial information. We've answered this question so many times, it keeps on repeating, but will not tire from answering. Number 1 is relevance. Number 2, reliability. Number 3, understandability. And number 4 is comparability. So this is just stating. What we've done is stating, but we are supposed to describe. So relevance, we must make sure that we capture all the significant or material information. And what is material information? Any information that can influence our decision making. Any information that can influence decision making is considered material. Any that cannot influence decision making or cannot alter decision making will be considered insignificant. But the bottom line is that we need to capture any and disclose all the information, because in accounting it is that simple, that one simple transaction that will have significance at the very end, especially when we now talk about the many transactions together. Reliability. This information must be accurate. Accounting information must be accurate, must be truthful, and it must represent a fair state of affairs. This also calls for objectivity. So all these put together will lead to reliability, where somebody can basically depend and say that information is actually true and it presents a true state of affairs of the organization. Understandability, this is about user friendliness. We need not to have account information that is so complex that somebody cannot comprehend. It needs to be user friendly, it needs to be simple, and it needs to be comprehensible. Somebody can easily understand and make meaning out of the information that has been provided. Then comparability is about uniformity. It's about consistency. All of us it's about following or adhering to the set standards, so that if we are all doing things that are related, things that can compare, then in that case it means we can always make meaning out of the information that we have. Otherwise, if everybody does his or her stuff, at the end of the day, you cannot even make a decision. You cannot know where you are. You cannot, So comparability is the uniformity in standards, uniformity in the way we present account information to permit users to make informed decisions. So those are the 4 qualities of accounting or financial information. Let's look at item C. Office Limited is an entity that manufactures and retails office supplies. It summarized financial statement for the years that and that are as follows. So we have sales, cost of sales, gross profit, operating expenses, finance costs, profit before tax, income tax expense, and profit for the year. Then we have, of course, the non-current assets. We have the current assets, they are there. We have the equity, we have the non-current liability, and we have the current liabilities. So what are we supposed to do now? We are supposed to calculate, number 1, the gross profit margin for the 2 years ended 30th April 2020 and 30th April 2021. So gross profit margin. What is very important in this, okay, they don't want interpretation, but possibly they will also have asked for interpretation. But you can see it's just 2 marks. So mark 2021, the other mark 2021 mark 2021, the other mark. Okay, so let's move. Gross profit margin. Gross profit margin, what's the formula? Gross profit, that's the starting point. Gross profit margin formula is gross profit over sales times 100. So for 2020 we'll have 2020 and then 2021. So 2020, then we'll have 2021. Let's just replace the formula and we'll be good to go. Gross profit for 2020, this is 243,900 divided by 695,900. So 243 divided by 695. 243 divided by 695, 900 times 100. Just like that. 243,900 by 640 by 695,900. Let me just check the figures to be sure. 695,900. So we are good to go. The other side, we have gross profit is 204,505 over 835,000. 204,505 over 835,000. 204,505 over 835,000 times 100. I hope we have it right. 204,505 over 835,000. Good. So let's compute this and see how it goes. Let's see how it goes. Sorry for that. Let's just get this calculator. Good. There we go. There we go. So 243,900, 243,900 So 243,900 divided by 695,900. That gives us, of course, times 100. So this gives us 35%. 35%. Then the other side, we'll have 204,505. 204,505 divided by 835,000. That gives us times 100. Of course, that will give us 24.5%. 24.5%. 24.5%. That becomes our gross profit. So gross profit margin, this is 35%, this is 24.5%. You need to know what that means. The next question might want to ask you that. Then you have ROCE. ROCE is return on capital employed. Here we are talking about the ability of the capital employed to generate what? The returns, sales. So what you are basically, the formula is EBIT. EBIT is earnings before interest and tax. Earnings before interest and tax over capital employed. Over capital employed. And capital employed can either be the equity financed by section, or the non-current assets plus current assets minus current liabilities. So it's either financed by section or the non-current assets plus current assets minus current liabilities. So let's come back here again. We have 2020 and we have 2021. So for 2020, this is EBIT, earnings before interest and tax. So earnings before interest and tax can also be the earnings, this one, gross profit, then we less what? Operating expenses. Less operating expenses. Interest is a finance cost. Tax, you can see this is tax, income tax expenses, and we are talking about earnings before interest and tax. So finance costs, we will assume these are interests, because it's not very clear unless if maybe there is something. Let's see if there is any clue that we have been given here. Bank overdraft, trade payables, current tax. I don't think if there's any clue. There's no clue here. So what we are going to do is this. We are just going to treat this as a finance cost. We'll assume these are the interests. So we'll take 243,900, that is gross profit minus operating expenses. This earnings before interest and tax. Let's assume this finance cost is what we have here are interests, and then of course this one is now tax. So earning profit before interest and tax, we just take gross profit less operating expenses. So gross profit, so this will be gross profit. This will be gross profit less operating expenses over capital employed will be the total assets minus current liabilities. Total assets minus current liabilities. So that's how we are going to tackle it. I hope we have these figures: total assets and current liabilities. And then current assets, total assets, good, we have total assets. And then we have current liabilities. Yes, we'll take these ones. Alternatively, we can also take equity plus non-current liabilities, and we'll still get the same answer. So let's move. So that is gross profit minus operating expenses. Here is our gross profit, 243,900. So 243,900. 243,900 minus operating expenses is 102,570. 102,570. 102,570 over 102,570 over total assets 439,260. 439,260. 439,260 minus, now this one we get the total here. We get the total here, or we just take equity plus bank loan. Total equity, this is the figure. So total equity, this one, minus plus 50, that is 294 for 50. 294 for 50. That is our figure. Let's see if we can get the same this other side. So this will give us, let's make use of the calculator, 107,750 plus that 7060. That gives us 144,810 minus, well, this is 439 total assets. That will be 439,260. This gives us 294 for 50. Yeah, it's the same figure. So we can go either way. 294 for 50. So let's come down here. What are we looking at? So since we chose to go the total assets minus current asset way, we'll take the total here. This is 144,810. What we have here, 144,810. Add this plus this, 144,810. So 144,810. Those are just two different ways of working it. You can either take the equity plus long-term liabilities, or you can take the non-current asset plus current asset minus current liability. Those are two different ways of working it. You'll still get the same answer. We've tried here and you've seen we've gotten the same answer. So the same thing, we can do it for 2021. So for 2021 it will be gross profit 204,505. 204,505. 204,505. So 204,505 minus operating expenses. What do you have under operating expenses? 96,870. 96,870. 96,870 over. So we'll go back, get this part. So we'll take total assets 623,060. 623,060. 623,060 minus. Now the other part, this is for this one, hopefully they have calculated for us. No, they haven't. So we'll have to add. So this will be 207,280. 207,280 plus 18,120 plus 18,120 plus 32,965. 32,965. That gives us 258,365. 258,365. 258,365. 258,365. 258,365. Good. So then let's get the answers here. Let's get the answers to this. So before we forget, ROCE is normally expressed as a percentage. So whatever figure we are going to get will multiply by 100. Most of the profitability ratios are expressed as a percentage. So this one is not an exception. It's also expressed as a percentage. So let's get this Workings here. Let me just bring this one here. Okay. So 243,900 minus 243,900 minus 102,570. 102,570. That gives us 141,330 divided by 141,330. So divided by, we have 439,260 minus 144,810. Though we had already done this, I think we go 294,450 here. 294,450 times 100. So the answer will be 141,330. Sorry, 141,330 divided by 294,450. Give us that one times 100, of course. We have 48%. So 48%. And then this other side will have 204,505. 204,505 minus 96,870. That gives us 107,635 divided by 623,060 minus 258,365. This gives us 364,695. 364,695 times 100. So that will give us 107,635 divided by 364,695. This gives us 29.5%. 29.5%. So that is our ROCE. That will be our ROCE. ROCE is used to calculate the profitability versus the capital efficiency. So that will be our ROCE. Though sometimes you'll get other books that are talking about net profit after tax, but basically it's earnings before interest and tax, and we have assumed that our finance costs are made up of interests. It can be a wrong assumption, but we've gone with that assumption. So earnings before interest and taxes over capital employed. And capital employed, we said it's the finance bisection, or non-current assets plus current assets minus current liabilities. Thank you. Let's move to the next question. The next question is interest coverage ratio. Interest coverage ratio. The formula for interest coverage ratio. Now we have so many interest coverage ratios. I'll stick to the most common one, which is the EBIT over interest. EBIT over interest. So this one, EBIT over interest, I think we already have EBIT. If we go with the same assumption, our EBIT here will be 141,330 over interest. Now our interest will be the finance costs. If that is what we assumed as our interest, we'll just come here, pick it's 8,400. 8,400. Now this EBIT measures, interest coverage ICR measures the number of times the company can meet its interests. Its interest can be met. So this will be 141,330. Just check again to be sure. 141,330 over 8,400, and the second one is 6,000. So I think we can just complete the whole of it. So this one, this part will have for 2020 will have 107,635 over 6,000. So let's get the answer. This one will be quite straightforward. So we'll talk of 141,330 141,330 divided by 8,400. So the answer we have is, this is 16.83 times. 16.83 times. ICR measures the number of times. So again, we come this other side, we have 107,635 divided by 6,000. This gives us 18 times. 18 times. So we have 18 times and 16.83 times. So that is our ICR, interest coverage ratio. 18 times, then this side we have 16.83 times, the formula being EBIT over interest, and we've already computed EBIT. Our EBIT is here, and then the interest, we've simply assumed that it is the finance costs. This finance cost, we've assumed is the interest. So good, let's move to the last one, and the last one is debt to equity ratio. The formula for this one is total debts, basically total liabilities over total equity. Total equity. So that's how to go about it. So total debts, we just get this. I think this should be straightforward from here. Total debts will pick from here. These are liabilities, we pick this total, and then of course we have the total equity. This has already been total, this has also been total. This is 72 plus this, 244, 450. So the total equity is here. Total debt, you have to add this. So let's just add them and see. This will be 50,000 plus 107,750 plus 37,060. 37,060. That gives us 194,810. 194,810 for this one. Then for the other one, we will have 37,000. 37,000 plus 207,280. 207,280 plus 18,120 plus 32,965. This gives us 295,365. 295,365. So 295,365, then 194,810. So let's get the answers. What do we have here? Total debts over total equity for 2020. We'll be talking about total debts 194,810. 194,810. So this is 194,810 over 194,810 over 244,450. 244,450. 244,450. 244,450. So this is a ratio. So 194,810 divided by 244,450. We have 194,810 divided by 244,450. This gives us 0.79. Let's call it 0.80. 0.80. It's a ratio. It's a ratio. So it means the equity generally is better than the debts, which is good. Now let's look at 2021. 2021 will also have total debts. Total debts over total equity. Total equity. So this our debt here is total debt is 295,365. 295,365. So 295,365 over. So this is a ratio. You can express it 0.8 to 1. And then 295,365 divided by 327,695. Divided by 327,695. This will give us the answer that we want. 327,695. Let me just compare get that number again. 327,695. So we are good to go. 327,695. So this will be 295,365 divided by 327,695. That gives us, let's just call it 0.90 to 1. It's a ratio 0.90 to 1. So debt is 0.90, equity is 1. So all the firms are doing pretty well. That is what was expected of us in question 1. Debt equity ratio we've calculated. Interest coverage ratio we've computed. Gross sale we've computed. Gross profit margin we've computed. And of course, there were some theories here which we've answered. So thank you. Let's meet in the next question. Subscribe, follow us, and you can also enroll for our classes. Thank you so much.